Howdy, Jacob here. Today we're looking at Medpace Holdings in the life science tools and services industry. They provide clinical research-based drug and medical device development services around the world. They offer a suite of services supporting the clinical development of phase 1 through 4. Okay, founded in 1992. I find it interesting that revenue has grown so substantially after being founded so early. Um, I do wonder if that's true. So, last 10 years, 8 years, it looks like CAGR has been over 20%, which is absolutely astounding on the revenue side, and earnings tenfold on the operating profit. So, very crazy. Return on invested capital is absolutely substantial, increased a huge amount. Gross margin is actually down from a little bit ago, but operating margin is up quite a bit. So interesting figures there. 245 million cash on hand with no short-term debt, no long-term debt, extremely safe balance sheet, no concern there. On the cash flow statement, we see that capital expenditures have gone up quite a bit, but so also have cash from operations. And so they are producing cash flow or cash from operations well in excess of their capital expenditures. And their use of cash seems to be pretty heavy on the share repurchases side, a little bit on the reinvestment side, and more recently buying back a little bit of that debt. But now they don't have any debt. So they can really focus on reinvesting at hopefully fantastic rates of return and then buying back shares when they are very cheap. So, quick review. Let's start making some assumptions. Revenue side, growth has been absolutely obscene. It's crazy. Um, it it looks to be, let's see, 18% insider ownership. That is awesome. That means that you invest there, they're likely going to be doing what's best for the business. So hopefully they're buying back shares that are cheap. Hopefully they're reinvesting at those massive rates of return. I mean, yeah, we'll see. Let's see. Let's do 12%, 22 on the P and price to free cash flow. Margins will bump up earnings a bit since it's so much lower than their free cash flow. Buying back shares at 12 million or 12 billion, that'd be about 1% is 120 million. And I think that they 120, 1.5% would be 180 million, and they can absolutely afford that. 2% would be 240. Yeah, I think them buying back 2% of shares is honestly pretty reasonable. And then with the remaining, let's do 1.5. So then the remaining 40% or so, 30 to 40% of their free cash flow, they can really reinvest back in themselves and try to get those rates of return that are 18, 29, 44%. Um, yeah, I think I'm comfortable here. It just looks a little bit expensive at this price point. So I'm just waiting till it drops a bit more to do more research on it. But company perspective, numbers perspective looks absolutely amazing. And I say it a lot, but every investment is the present value of earnings or free cash flow. So although the business might be absolutely fantastic, it might be a little bit overvalued. And of course, I could be wrong. Maybe their revenue growth is 20%, their margins are 25% over the next 7, 10, 15 years. I could look absolutely wrong. But I'm making assumptions that are going to be conservative to my perspective that I think is the most likely output to happen. And for right now, I just think it's a little bit overvalued, so I'm gonna wait. Hopefully you enjoy the video and have a great rest of your day. Thank you.